Hey everybody, this is Hu Brietikopf with the Insurance Guy Financial Services. And in today's video, we're going to be speaking about mortgage insurance and life insurance. With mortgage insurance, the main differences about this is that the value decreases as the mortgage decreases. What does that mean? That means that if you originally purchased your house for, let's say, $500,000, you want to have it insured. It's good when the value decreases, and let's say it's now $450. So now your mortgage insurance now goes from $500 to $450. So it follows the house as it goes. So if you owe $100,000, you also owe, the mortgage insurance is also $100,000, just enough to pay for the property. Secondly, it only protects the lender. So what does that mean? It's exactly what it says. It basically doesn't go to anybody else. It goes directly to the bank. You pass away, all the money that you owe for the bank is basically wiped off. All the money goes directly to the bank. Thirdly, you may have to qualify after you renew a term. So if you decide, you know what, I want to be able to test the markets. I want to say, you know what, my bank's not giving me the good rates anymore. I'm going to go to this new bank. Well, you know what? You might have to requalify simply because they've never qualified you before, and so now you're 5 years older. You may or may not have issues. If you're healthy, no issues. If let's say you have high blood pressure or you have diabetes or anything like that, you'd have to requalify with the bank and pay their rates at that time. So every time that you want to renew, you're going to have to do it that way. So in this case, you might have to stop going to a different bank because you have an illness. Do you want that? You know. Lastly, they do post-underwriting. So what does that mean? Post-underwriting basically means in the initial stages when you first have your mortgage, they give you 2 pages. They say, you know what, fill these yes/no answers. Good, you're qualified. We give you coverage. You start paying. Now you pass away. What does that mean? Sorry, now you pass away, and now that's when they start their underwriting process. And usually their underwriting process takes about 6 months to complete. And during that 6 months while you're not alive, your family will actually have to pay the premiums for that whole time. And at that time, they may or may not decline you for insurance. So they say, you know what, would we have taken this person 20 years ago when they had applied to us, or would we have not have? If you didn't qualify, thank you for paying all those rates, but I'm sorry, you're denied. The difference between mortgage insurance and life insurance: with life insurance, the value stays the same for the entire term. So if you buy a policy for $500,000, it's worth $500,000 today. It's worth $500,000 15, 20, 25, 30 years from now. It's for whatever term that you decide. So if you owe $200,000 on your house, you still have a $500,000 policy. So it's very, very portable in that case. So you'd be able to take it from this house to the next house to the next house that you buy. So, so if you owe $200,000, that extra $300,000 could be used for something else, funeral expenses or raising your children or anything like that. So in essence, the beneficiary receives lump sum. So the insurance company says, you know what, he's passed away, here's a $500,000 check, you decide what you want to do with it. Thirdly, the price stays the same. So there's no fluctuation in prices. So if you decide I want to buy a 10-year or 20 or 30-year term, the price is, let's say you buy a 30-year term, it's $50. It'll be $50 today, $50 15 years from now, $50 25 years down the line. So it'll always be the same. The best thing about buying life insurance over mortgage insurance, it's pre-underwriting. Yes, you have to do a little bit more work in the beginning. A nurse may or may not visit you for a blood and urine sample, but it's those tests that tells you, yes, based on today's health, they are healthy. We will take them based on today. So if they die 5 years, 10 years, 15, 20 years down the line, we will pay them those rates. And typically you can get paid 3, 4, 5, 6 days later, 2 weeks later, but it's not nowhere near 6 months later. So you'll always know upfront how your payment's going to be. Well, anyways, that's just a kind of brief synopsis of the difference between mortgage and life insurances. And hope you enjoyed the video. Remember, don't rely on crowdfunding, go fund yourself.